Hi, I'm Evan Weinberger. I'm a reporter with Bloomberg. I cover fintech, banking, all sorts of fun regulatory policy. And I love covering state regulation because it's always exciting. But you don't want to hear from me? Let's introduce our panelists. Susie,
sure. My name is Susan Seaman. I'm a partner at Husch Blackwell. I'm located in Columbus, Ohio. I'm a regulatory attorney, and I advise on a lot of different federal and state laws that affect lending, payment, and deposit products. I have a deeper knowledge in bank partnerships, federal preemption, and multi-state compliance. I spend a lot of time on state laws, and I think that's why I was tapped for this panel. So it's nice to meet you all.
Good morning. I'm Marc Franson, a partner at Chapman and Cutler, a national financial services law firm. I'm based in Chicago and head up our regulatory compliance and fintech practice. And many of you are familiar with the publication that we put out every year now for the 15th year, the regulation of marketplace lending. And so if you don't have a copy of that, check our website, chapman.com, or I actually have cards with a QR code on it that you can download it, but it's a resource guide, historical as well as updating all of the regulatory aspects of marketplace lending.
Good morning, my name is Brent Schecter. I am in-house counsel with Avant. We are a financial technology company, and through our partner bank, facilitate access to personal loans and credit cards. We are located in Chicago, Illinois.
Hello, I'm Brent Adams, Senior Vice President of Policy and Advocacy for Woodstock Institute. Woodstock is based in Chicago and does consumer financial protection and community economic development. Lately, particularly as it relates to my own professional career, we specialize in consumer lending issues. Specifically, when I say consumer lending, I mean predatory lending.
Okay, and I'm actually glad that we have a very heavy Chicago contingent here because, as many of you know, Chicago in the last couple of years has instituted a 36% rate cap. Other states have followed suit. There's been a lot of work on earned wage access in the states, buy now, pay later. So I guess our panel's title is How is this helping or affecting consumers? Maybe I'll just start. How are all of these changes at the state level affecting the way consumers are able to get access to loans, to get access to credit and other financial services? Maybe Susie, you want to start?
Sure. So I think so the state law creates underlay under federal law that is complex and opaque, right? We have, if you include the territories, we have 56 different jurisdictions who are independent actors who have their own, within their state laws, can have their own unique consumer protections and credit laws and other regulations. And so there's just a complexity and volume there to keep track of. But also and we can get into this a little bit more, but there's an opaqueness that you have at the state level that you may not have at the federal level if that is where you focus your attention. So I think a few of the things that come to mind in terms of effects on consumers, heavy regulation has an anti-competitive effect, right? And Director Chopra, who we're going to get to hear from later today, actually had a blog post when he first started his time at the CFPB, advocating for simple regulation and committing the CFPB to issuing more guidance, clear rules of the road. And he mentioned a lot of the consumer protection issues and having complex, opaque regulations and the need for simple rules of the road. And one of them is, a barrier to entry. We don't have as many players in the space, and we all like friends in this room, right? So that can hurt consumers, that can hurt innovation. And also one other thing and I'll let some others chime in here, but also disruption. You build a product around a certain regulatory scheme, and then when things change, you may not be able to access that product or provide that product anymore in that state or to certain bands of customers. And so, we hear a lot about continuity plans and making sure, you have your backup bank partner, but there's a disruption in availability of products that can hurt consumers. But if anybody else has sorry, that's your role, right? Yeah. Anybody else have anything to add?
Yeah, actually, Brent, maybe from your perspective, looking at it from the consumer advocate side, how do you view it?
Well, first, there's a premise that is oftentimes adopted by our industry friends that more lending means more happiness. So rather than just adopting that premise, we commissioned a poll that asked about things including support for the rate cap, how are you accessing funds, so on and so forth. And the results of that poll were resounding in terms of support for the rate cap, as well as the fact that folks are doing a variety of things to access emergency cash. Many things that don't include lending, or include lending that does not appear in credit bureau data. So I think that's kind of important. So we think that the law is working. We will be releasing a report later this year, a comprehensive report that basically is titled The Predatory Lending Prevention Act is Working, and we'll have a variety of pieces of data. One big data point is that based upon data reported to the state by the high-cost lenders, consumers in Illinois have saved over $600 million. We were the fourth highest state in terms of the amount of fees paid to high-cost lenders, and now consumers have saved over $600 million. So that is a big win in our regard, in our opinion, I should say.
Okay. Marc, just your thoughts on this?
Yeah, I'll maybe take the other side of that issue, and that is credit access. And while I think certainly a lot of state laws and implied protections of consumers are well-intentioned, they oftentimes have unintended consequences. And every study that has ever been done after some of these state laws that have passed have indicated that this decreases access to credit. After the Madden decision in New York, denied access of credit to large numbers of people. I'm from Illinois, and the other side of that coin is people may have been saving money, it's because they can't get loans. And there's not the access to credit that there was prior to that law being enacted. And most recently, for instance, Nebraska enacted a licensing law that pretty much affects everybody on the spectrum, marketers, servicers, and even securitization trusts who purchase marketplace loans, requiring them to get licensed. And what we hear from our securitization clients is, if you have to get a license in Nebraska for holding loans above 16%, we're just not going to put them in the asset pool, and therefore consumers in Nebraska aren't going to get loans above 16%, at least from the online lenders. And 16% isn't all of that high a rate, but it's going to shut off the credit access to those people. And so I think the problem with state laws is with such a broad brush stroke that we're also cutting off a lot of things that really are hurtful to the consumers, hurtful to the economy, hurtful to the capital markets system and the liquidity that people need.
So Brad, Avant is a company that issues loans at below 36%. So you guys are still allowed to operate in Illinois and New Mexico and other states that have these new rate caps. How do you see this issue? How do you see state regulation affecting your customers and other consumers?
So at the core of everything we do, we believe in sort of, moving consumers' lives forward with responsible credit. So we're always going to be in favor of responsible credit. That being said, there is an enormous burden that these, sort of the patchwork of state laws, Susie mentioned, 53 different jurisdictions, just the manpower and the effort it takes to track these laws, to calibrate our platform, to calibrate our system for different things. This is all energy being taken away from innovation and our ability to do other things. Because every time there's a state law change, there has to be an engineering change in the background. It's not as simple as just flipping a switch. That you have to do something in the background to comply with those laws. I mean, that's sort of, one of my core responsibilities is to ensure that our company, that our program through our partner bank is in compliance with all these different state laws. Brent mentioned that people are getting credit from elsewhere. I don't know where else, but I mean, one of the biggest things is at the end of the day, our programs, being from Chicago, right? I mean, there's the outfit, I guess. There's, payday lending, there's pawnbrokers. I mean, there's other things, but I think you're much better off taking, loans from a supervised program, and these programs are unbelievably supervised. You have the federal level, you have the Truth in Lending Act, from a supervised program that has very clear disclosures and very strict sort of, terms and conditions around how these loans need to be paid back.
Okay.
And I think that the state patchwork just discourages innovation and provides an unnecessary layer of burden on companies like ours.
So Brent, just curious, you mentioned that people are getting loans from sources that aren't affecting their credit score, not traditional lenders. Can you tell us where else people are
Sure.
going?
I use the term credit loosely because it's controversial, but earned wage access, for example, that's not reported to credit bureaus. And that's a source of funding that you can get for literally $0. So that's just one example. Loans from charities also is another possibility. So there are a variety of different things that fall within that category of loan.
Okay. And when you mentioned Director Chopra, Susie, and one of the first things that he did also was tell state regulators and state financial regulators, we would like, and attorneys general, please be more aggressive in enforcing federal consumer finance law. How have you seen that played out?
Yeah, so I was trying to think about like how it's changed under Director Chopra, because I think states have looked to the CFPB since it was created to set regulatory priorities, right? I mean, they are a primary federal regulator, and that is a natural relationship. I mean, I think one of the most, a discrete example recently is the CFPB's, scrutiny of medical financing. Illinois, since we, in Ohio, but mostly in Illinois, just introduced a medical financing disclosure act, right? So you see that kind of play out in taking their cues, and that's always, I think that's been the case. Where I think things have been different under Director Chopra is the CFPB has issued more guidance, right? We're starting to see these things called circulars and interpretive rules and policy statements. And I think the effect of that guidance that's being issued, I mean, the abusiveness policy statements, circulars that are, directed towards other regulators that have overlapping jurisdiction with the CFPB. I think all of that guidance is giving states more confidence to use not only their federal authority under the Consumer Financial Protection Act, but also, look at their own state laws and all the tools that they have, because they feel more comfortable. Like the abusiveness policy statement was basically the CFPB summarizing all their viewpoints on, or all of their actions and assertions of abusiveness. And it really gives, and I've actually heard this from a state AG, it gave me a much better understanding of how to use abusiveness and assert those claims. So I think that it's just, the CFPB is encouraging states to use the tools that they have at their disposal more, and might be causing them to be more active.
And Marc, what's the impact of that?
Well, I mean, there are certain effects of that, and certainly, sort of states' rights versus federalism has been around since the founding of the Republic, and we're seeing it come into play in the marketplace space. And I think, even though we're getting more direction from the CFPB and maybe emboldening, some of the states, what we're also seeing is, I guess, what I'd call an end run around federalism. For instance, when the federal banking agencies enacted, in essence, the valid when made rule, we started seeing states coming into the fray in terms of trying to do an end run around those federal regulations by talking about regulating entities, particularly marketplace players, for various reasons. And for instance, having a predominant economic interest in a loan, which no one or no law has ever defined. And in fact, since a lot of these loans are packaged and sold off, really the predominant economic interest is with many of us in the public who buy into securitizations or funds or people, and that wasn't the intent, of those particular laws. So I think what we're seeing is again, some more confusion, some more uncertainty that goes into what Brad was talking about, that it takes a lot of time and effort for platforms and companies to come to grips with. How do we handle these things? And ultimately can lead to litigation, which is also time consuming, which is expensive, and again, takes away from innovation, takes away really from the access to credit, particularly for, I think, pretty much everyone in this room who is in favor of responsible lending. And great, if there are bad actors, let's get them off and punish them, but that's not a reason to also then eliminate all of those who are doing this responsibly.
Okay, and Brent, I mean, how do you view, Illinois has a very active state attorney general, as a blue state attorney general who's gone after a lot of lenders. Are you seeing more out of state AGs trying to enforce federal consumer laws as well?
No. In fact, I've tried to encourage certain players to take action based upon that guidance because of the absence of a state law to allow to do so. So that hasn't been successful from my perspective. One thing I want to comment on is in terms of this complexity of the state laws, what have you. Before our 36% rate cap, we had a mess of laws that applied to different types of loans, different amounts, different terms. The 36% simplified things. And that is part of the reason we are in favor of a nationwide 36%. Just cap it all at 36% and stop the whack-a-mole phenomenon where the less regulated loans get, the market gravitates to the least regulated space, as well as the industry. That's what we've seen. And that creates the whack-a-mole phenomenon that we've battled for years and years and years. So 36%, among other things, has the beauty of simplicity.
Okay. Brad, I mean, you mentioned before how you spend a lot of your time monitoring different state laws and, getting the, Avant systems up to speed on that. Can you talk a little bit about, what that looks like, how you do that and how complicated it's getting?
I have really good people on my team whose jobs are to do that. I mean, it's actually, it's funny, Phil at the very beginning mentioned the AFC board meeting last night. It was actually a topic of conversation. Everyone asking, like, do you have a good tool that you use? There isn't a great tool in the marketplace. There are tools, but they're also as good as you sort of calibrate them. So, I talk about sort of like the big funnel, and we try to, whether it's utilizing, email blasts we get from law firms, things that we get from the AFC, our own investigation, things that we hear colloquially, try to all bring it into this funnel, and then you can sort of analyze it, determine, is this something that actually impacts the products and services we offer, or does it not, and then go from there. But it is an imperfect science, and it's difficult. I just can flat out say, I mean, it's not an easy thing to do to monitor all these different states. Inevitably, every few months we'll get caught off guard. There'll be something like, oh, we did, and you're sort of scrambling to catch up. As good as you think your net is, you're monitoring for it. I was in the roundtable earlier, complaints, and there was a state law that was mentioned that I think every one of us in the roundtable quickly scribbled on a piece of paper, like, oh, we got to go back and look this one up when we get back, because none of us knew about it going in. So it's an imperfect science, and it's difficult, and it's costly, and it's time consuming. Right.
So a lot of state law issues are sort of dealt with on sort of a red state, blue state manner. Is that really, does that extend to these sort of financial regulations and financial services laws? I mean, Marc mentioned the licensing law in Nebraska. Nebraska is a very red state, and there's 36% interest rate caps passed by referendum in several states that would be classically considered that as well. So is that the right way to be thinking about how states look at consumer protection, or is it more complicated and maybe purple than that? Marc, maybe start.
Yeah, I think it's more complicated than that. For instance, to give another example, a while back, Utah enacted commercial loan disclosures for non-banks, and a growing number of states are doing that. And part of the problem of that is, while all these laws are similar, they're also different, and so it creates, on the commercial side, not just the consumer side, some real disparities in how do you deal with that, how do you comply with that, and all sorts of things. But Utah, again, is not a blue state, and yet here we have regulation. So I don't know that that's the appropriate way to look at it, and certainly we see a lot of politicization of issues in our day, but it really, I don't think you can just draw those lines on that basis. Certainly there are some states that are in either camp, and you can see that they have certain implications, but I don't think that's the way to do it. Some regulators are more aggressive than others. I think some of these laws are coming from those places. We've seen some states and some of our clients get enforcement actions from where you wouldn't expect them at all, and then other states where you would expect they would be coming in droves, and they're not. So it's sort of interesting. For instance, we had an attorney general action against one of our clients recently, and they essentially wanted a settlement of paying consumers who were being charged more than 36% in that particular state. And by the time they got through their investigation, virtually all the loans were paid off, and there was nothing to give to the consumers. So, and that was a red state. So it's more complicated, I think.
Susie, how do you see it?
Yeah, I agree. Maryland is another example where they have a Republican governor, but their laws are very hard to navigate, their credit laws. And, we know that the regulator has issued guidance on earned wage access that people may or may not have found helpful. And so I think, you can't go red, blue. I do think that who's running the state does help inform the regulatory environment, right? I think one part of this whole state patchwork or mess, however you want to put it, is you really need to know the regulatory environment. And there is a lot, you can read the plain language of the statute and see what the legislator brings about, but the regulatory expectations, how regulators on the state level interpret their own laws can be opaque. And there are pressures that happen behind the scenes that are not in the public forum, where they take certain views on products. And I think that is can be a big blind spot. And it's also hard as outside counsel to always know, right? Because we rely a lot on plain language and public guidance and to help advise our clients. But then you get in these conversations that are more backdoor, and you're like, wait, you take what point of view on what? And like, where is that in the statute? And again, to do that times 56 jurisdictions, if you include the U.S. territories, that's challenging.
Brent, how do you see it?
Well, I'm sympathetic to the concern about the multi-state compliance issue. I was the former head of the state financial services regulator agency. So I bring to this conversation to both the perspective as an advocate and a regulator. So I recognize it as being a challenge. I began my career as a litigator for one of Chicago's biggest law firms representing corporations of all sizes. So I recognize it as a challenge, and it is part of what informs our belief that there should be, in many cases, a nationwide standard that's a good standard. So we, that is that's not our leading talking point, of course, because that's not the constituency we represent. But it is, in fact, a valid concern that we think would be solved by a nationwide standard.
Okay. When you have different levels of regulation in different states, Brad, how do you kind of design your product to meet the standards of the strictest states, or do you really have to tailor it for each state that you operate? I know that Avant doesn't operate in all states. I'm from New York. You're not there because we have the state has really low interest rate caps. But how do you do it? What's the strategy?
I'm sorry, can you repeat that again?
Yeah. How do you target your product for the strictest state and then kind of make small adjustments for less strict states, or do you tailor them directly for each company?
I'll give the lawyer's favorite answer to that, which is it depends. Yeah. It depends on the regulation. I mean, at the end of the day, right, so if you're talking about something like the SCRA, Service Memorable Civil Relief Act, right? So you have various state corollary laws. Yeah, that's one where, you can just sort of calibrate yourself to, the strictest state, what be it, and let that run. On the flip side, obviously when you're talking about interest rates, no, you're not going to do that. We're not going to, calibrate ourselves to whoever has the lowest interest rate sort of thing. So it truly does depend on what the regulation is and what the, what the law is.
Okay. And Marc and Susie, how do you advise your clients on that kind of situation?
It's difficult because take for example a couple of the more innovative products, earned wage access and income sharing agreements, for instance. You've got states on both sides of the issue. In some states, earned wage access is a loan. Other states have come up with legislation that says it's not a loan. Same in income sharing agreements. The CFPB and several attorney generals have sued, saying these things are loans. Other people said, well, there's no real repayment obligation, so it's not really a loan. So how do you navigate, those particular waters? And unless you, again, exclude states because of that and therefore, affect credit access, it becomes difficult to have both a national program and the compliance risk becomes huge, as well in those. And there you go back to innovation. And okay, these are maybe really good products for people, and yet we're playing litigation games rather than delivering those products to the people. So it's hard to navigate those waters.
Okay.
Oh, I would just add, I do think one valuable exercise that I haven't advised clients on in the past or advise them to do this, but I do think if you have some time, even though we have to keep up on all these state laws and federal laws, I do think it would be advisable to go through with your business partners and say, okay, in each state, like what are our states that are so significant to our program? Well, first of all, threshold question. Being available nationwide, is that important for us to get investor money? Is that an important business priority? And then also diving into each state and knowing, okay, here's our customer base here, here's how important it is in our business. And I think looking from the business side informs your risk strategy, because there's uncertainty, there's silence in the law, and so we need to make risk reward decisions. And I think having more of a granular level of the big states or how much is Connecticut important to us? I think that's a good exercise to do maybe over the holidays when it's quieter, with your business partners, just so that you're more informed as a regulatory advisor. Okay, if something changes, if a state pivots, if they take an interpretation that is not what we thought was a reasonable interpretation based on the publicly available guidance, how do we pivot? We already know how important this particular jurisdiction is. So that's a thought to add to.
I feel like Connecticut has taken a little bit of a
I
beating.
know. Well, we could do Rhode Island.
One.
Rhode Island has crazy things too, but
Okay, and so what is the impact on innovation? We're seeing new products all the time. We're seeing earned wage access, income share agreements, buy now, pay later. Things like that are developing. But what is the impact of this kind of patchwork state regulatory environment on innovation altogether, Brad?
Well, I'm sorry, was it Brad or Brent?
Brad.
Okay. Well, what I think you're seeing is companies like ours, and we're not alone in this, are actually, sort of pulling back and focusing more on core products and not offering, more innovative products right now as a sort of nod to the environment we're in, both financial and regulatory. I was looking at, I won't name the company, but a publicly traded company went out with their earnings last week, and that was one of the big statements was that we are going to get out of XYZ business units, XYZ products, and move ourselves more back into our core bread and butter. So I do think you're seeing actually a chill on innovation.
Brent, is that necessarily bad? I mean, is that preventing potentially harmful products from coming to market because companies are being more careful?
Well, yes, but at the same time, we have been actively encouraging the banks and others to be more aggressive in trying to develop products to serve communities that have the highest need, the unbanked, underbanked, and so on and so forth. And we have a resource guide that we publish where we specifically identify the banks. This bank has a great product. So a lot of our allies are kind of hesitant to specifically name banks that they think are doing the right thing, but we don't hesitate to do that. So we're trying to encourage the good activity and to work in a partnership with the banks and the other financial services providers in developing good products.
Right, just given the audience here, do you name fintechs as well that are providing good products for folks?
I'm sorry?
Do you name fintechs as well that are providing good products?
Yes, and we have earned wage access in there. Which is very controversial.
But you're not going to see the big banks. You're not going to see the big banks getting into a lot of this space. They can't.
Right.
They can't lend to consumers with FICO scores under a certain level. Their regulator, the prudential regulator, just won't let them. So it is on us, it is on our, the people in this room here today to do that. I mean, that is why this business and this whole industry grew coming out of the financial crisis. Because, I come from a big bank in prior life. That company did not lend to consumers under a certain FICO score. And that's just the truth.
Do you find that it's, bank partners have a difficulty, do they raise questions about the low FICO scores that you lend customers that you lend to, or is it because you're doing the credit checks and know your customer that banks are able to allow this to go on?
Bank partners intimately involved in everything. They know exactly, they have their own data, they test the models. 100% they're engaged and involved, and if they don't like it, they will kill it.
Okay, and Marc and Susie, your thoughts on this question of what all of this complexity means for innovation?
Yeah, and some of the innovation is driven by capital markets, right? And what we see when all of these state laws come into being is elimination from the eligibility criteria for securitizations, asset-backed securities. And, I think, 5 years ago, the list was, small. Now the list is growing as more and more states come into the fray. And so, again, I go back not only to credit access, but the fact that we're spending so much time in dealing with that patchwork of state laws that, we're not spending the time on more innovative products, refining the products, and as Brad alluded to, going back to the original products, which may or may not meet the needs of credit and communities that we're trying to also serve. So it's a bit of a conundrum there.
Okay, and Susie?
And just what I would ditto to everything, but just two other things I would add is we've seen a lot of modernization in state laws, or a good chunk of it, and now state regulators have more tools, and so that's good progress on that front. But there still are state laws that make it that stop innovative products from happening, that are antiquated, like requiring monthly payments on installment loans. I mean, that stops us. This is just a discrete example, but that stops us from offering more flexible payment options to consumers, and that's on the books in some states, right? So I think there's still this element of antiquated laws on the state level, but also there's still also a gap with state regulators in understanding innovations on the market. I mean, they've made leaps and bounds from my experience, and not all states are on the same level, right? I don't mean to be disparaging, but there's still a gap there, and I think there's also a tendency sometimes to paint different programs and different products with broad brushes, because that's what we know. I actually recently had a regulator try to explain to me how marketplace loan programs, how they're normally structured, because my argument was that my client had a different structure. And I was like, yes, I know. I mean, I was kinder, but I was like, yeah, I've been doing this for, I know how they're structured typically, so I still think there's a gap there relative to federal regulators, but again, Illinois is very, very on top of innovation. New York, California, and other ones, I'm not saying, again, broad sweeping, but those are features of state law.
Okay, and what do you think the future is at the state level for are there products that you have your eye on that states are going to be taking a more active role on? Are there states in particular that you look at that have anything that's coming up that you think people should be thinking about? Marc, you're nodding your head.
I think when we see the next state legislative season sort of open up in January, we're going to see all sorts of legislation in this arena. It may be trying to regulate buy now, pay later and other new products. It may be opt out of federal preemption like we've seen in Colorado. It may be more predominant economic interests. They seem to have some panache, at least with some legislators. So I think we're going to see much more activity, and that's going to be complicating in terms of what fintechs have to do if these things become passed. And it also, I think, sort of behooves the importance of organizations like the AFC to help monitor, to help lobby, to defend the industry. For instance, the Colorado opt-out legislation just sort of almost like the Illinois 36% rate cap. Nobody knew about it until it was almost enacted. And not even the state regulatory agency in Illinois knew about it until it sort of came up. So, it's important to have people and associations monitoring these things and being proactive, rather than just, we have this new law now, and we've got to comply with it. So,
Brent, what do you have your eyes on for 2024 and beyond?
Well, I think the arc of history is trending towards rate caps, and it's trending toward increased disclosures in the small business space. Illinois, we've introduced a bill to establish a regime of registration of non-bank small business lenders and APR disclosures. And so our bill is based upon New York's. So I think that's the trend, is that you're going to find increased, and again, sympathetic to the patchwork and the difficulty of regulatory compliance. But at the end of the day, my choice is between the complexity of compliance versus protecting consumers. I'm going to protect consumers every time.
Okay. Brad?
I'm going to join Brent and walk over to the Capitol Hill and talk about a federal standard. After this, no, I don't see it slowing down. I don't see it slowing down. We seem to be, if everything's a pendulum, we seem to be in, definitely moving right now more towards more. So I as much as I would love to say it's going to slow down for my own personal well-being, no, I think it's going to be a busy 2024.
Okay, and Susie?
Yeah, I think to sum up, when one state acts, the question is, will it persuade others to act similarly? And then if they do act similarly, is it uniform, or do they have quirks like each of us and states have? They're all little people. I don't know. But anyway, so some of the newer laws that are coming on the books, like grace period for credit card rewards in New York, that becomes effective in December. Will other states pick up that? Anything that's kind of newer, and one state's doing, I think the watch out is, will other states do it too?
Okay. So I don't want to keep everybody from a break, but if anybody has any questions. No? I think we answered everything. Good work.
Thank you very much.